Ever jump into a trade like you're about to make a killing? Then bam, your profits disappear quicker than a cheetah, on those commercials.
Right, we've all been there.
Forex can be a wild ride, but is there a way to handle those market swings with, I don't know, a little more, I guess, finesse?
Yeah, and that's where understanding these risk-reward ratios really comes in. It's not so much about magic, but more about a solid plan so you can protect yourself
Yeah.
while, chasing those gains.
Which is what we're diving into today, this whole risk-reward ratio thing, or RRR. We're using this piece, risk-reward ratios,
Managing your risk from hand-tech markets to guide us.
like a treasure map. Right. It'll take us through RR so you can trade smarter, no crystal ball needed.
So no more just winging it. Sign me up.
Exactly.
But let's start with the basics. What is a risk-reward ratio when we talk about Forex trading? Okay, so imagine you're looking at this trade and you think, this could be it. The risk-reward ratio helps by asking, okay, but if I'm wrong, how much am I okay with losing compared to how much I could gain if I'm right? So you're weighing the possibilities, really.
So it's not just about, like, going for the big win. It's about knowing how much you're really cool with putting out there for that chance.
Exactly. Like, would you rather bet, say, $1 to win $5? Or bet $5 but only win 2?
And in Forex, this is super important because things change so fast, don't they?
Yeah, you got it. Forex is volatile for sure. Prices swing up, down super fast, so having a plan for winning but also losing, that's key.
Makes sense. So to use this in the real world, what are the terms we got to know when we're talking about RRR?
Okay, let's break it down. First, entry price. That's just the price when you jump into the trade, so buying or selling a currency pair, your starting line.
Simple. Now the part that makes everyone sweat a little. Risk.
Right, but risk isn't always bad. It's about knowing that not every trade's a home run. Risk in RRR means how much money you're comfortable maybe losing on this trade, a safety net. People usually show this as a percentage of all the money they trade with.
So say I have $10,000 to trade and I'll risk 1% on a trade. I'm basically saying, all right, I'm okay with maybe losing $100 on this one.
Exactly. It helps you manage risk overall so one bad trade doesn't clean you out.
So we've covered what could go wrong. Now for the fun part, the potential reward or take profit.
Now you're talking. Take profit is all about knowing when you cash out. It's the price you set where you're happy with your gains and you get out before the market, potentially turns on you.
Lock in the win, doing the victory dance, all that.
You got it. But let's not forget our safety net, right? The stop loss. That orders like insurance for your trade.
So if things go bad, the stop loss closes the trade at the price we set to, like, minimize the damage.
Exactly. No watching your account balance free fall.
Okay, so we've got entry price, risk, take profit, stop loss. But I feel like there's more to this RRR thing, right?
Yeah, there are some other things to think about, like lot sizes or leverage and spreads. They all can change your risk-reward calculations.
Okay, this is where it gets kind of tricky. So let's unpack those extra RRR ingredients. Like, what exactly are we talking about with lot sizes?
Lot size is just how many units you're trading. It's like ordering a pizza. You got your small, medium, large, right? Each one's got a different number of slices.
So a bigger lot size is like more units, more potential for gains, but also more you could lose, more slices, more pepperoni, more at stake.
Exactly. In Forex, that standard lot is 100,000 units of currency. So one lot of EUR/USD, price moves 1 pip your way. That's a tiny Forex move. You make $10. But a mini lot, that's 10,000 units, same pip move is only $1.
Makes sense. So lot size is like picking the pizza size that matches how much risk you're hungry for. Okay, then how does margin fit in?
Margin's basically a deposit your broker holds while you're in a trade, like a security deposit on that Forex piece, so yeah. And the thing is, the margin you need, it changes depending on how big you're trading.
So a huge order, like the biggest pizza possible, needs a bigger deposit.
Right. And here's where it gets interesting for RR. So you've got $10,000 in your account. You want to trade a standard lot, might need around a $1,000 margin. If your stop loss is 50 tips away, you're risking $500, so 5% of your account, on just that one trade.
Whoa, okay, that's a lot. I'm seeing how if you don't get the margin part right, it can mess up your whole RRR plan.
Oh, for sure. And we haven't even talked about leverage yet. That's like adding extra toppings, more exciting, but, potentially messy.
Leverage, the double-edged sword of Forex. You can control bigger positions with less of your own money earner.
It's like your broker's lending you money to trade more. Leverage of 1.1 euro, you could control $100,000 with only $1,000 of your own.
So it's like, what, a financial booster seat or something?
Kinda, yeah. But here's the thing about leverage in RR. It can supercharge your profits, but also your losses.
Like adding jalapenos to the pizza. A few's nice, too many, and oh boy.
Exactly. Say there's a trade, 1.2 RR. With $1,100 leverage risking $100, you could make $200 profit. But bump that leverage to 1.500, same $100 risk, now it's $1,000 profit or $1,000 loss.
Okay, seeing the appeal, but I'm also feeling the heat a little. So leverage is a powerful tool, but not for the risk averse. What about these spreads, though? They sound like the delivery fee in Forex.
Uh-huh. Good one. The spread's just the difference between the buy price ask and sell price bid of a currency pair, basically the cost of doing the trade.
So wider spread means the price has to move more my way just to break even before I profit.
Yeah, that's it. Wider spreads take a bite out of profits, so they affect your RRR. Okay, so with all that in mind, let's get into how to calculate this risk-reward ratio since it's so important.
Time for, I guess, a little RRR math, but no calculators, I promise. How do we actually get to this risk-reward ratio number?
The formula is easier than it sounds. Take your potential profit, so that's your take profit price minus your entry price, right? Divide that by your potential loss, which is entry price minus your stop loss price.
Okay, so say I'm looking at EU or USD, entries 1.1050, stop loss at 1.1000, and I want to take profit at 1.1150. How's that look?
All right, so your potential profit there is 100 pips, right? 1.1150 minus 1.1000, a potential loss is 50 pips because 1.1050 minus 1.100. Now you divide that profit, the 100 pips, by the 50 pips loss, and you get an RRR of 2.1.
So that means I'm aiming to make twice what I'm risking on this trade. Not bad. But with RR is bigger, always better then.
That's where it gets interesting. A big RRR, yes, sounds like winning the lottery, but there's usually a trade-off. Higher reward. Often means higher risk, too. It's like picking between the roller coaster and the merry-go-round at the park.
I'm definitely more of a merry-go-round trader myself, especially with my money. So how do you find that balance, between playing it safe and then, too much risk?
That's where position sizing is super important. It means figuring out the right amount of money to put on a trade based on your RRR, but also how much risk you can handle overall.
So choosing the right size plate for my Forex food.
Right.
Don't want to overeat and get a tummy ache.
Exactly. Say you see this trade, 1.4 RRR, so you could quadruple your money, tempting, right?
Yeah.
But higher reward, usually higher risk, too. You might put in less money there compared to a trade that's, I don't know, 1.2 RRR, more modest.
Because even though that big win is really shiny, got to make sure you don't lose more than you can afford if it goes south. So if there's no one right answer for the perfect RRR, how do I know what's best for me?
It's about finding your own RRR sweet spot. That starts with knowing your goals for trading, how much risk you're okay with, and what's going on in the market right now. Like choosing a hiking trail? You up for a hard climb or more of a chill walk in the woods?
Definitely the chill walk.
Right? And just like with hiking, it's smart to, start slow. As you get more experience, then you can take on a bit more risk. Remember, Forex is a marathon, not a sprint.
Okay, so we covered what risk-reward ratios are, why they matter, and how to use them. As we wrap up, what's the main thing you want listeners to take away from all this?
That getting this whole RRR thing, really using it, that can make you a better Forex trader. You'll have more confidence, more control, even though the market can be unpredictable.
It's like having that roadmap and compass, getting you where you want to go financially. We covered a lot today, but there's always more to learn. Keep trying things out, keep getting better at your strategy, and most importantly, have fun with it, right?